Hello, everybody. Alrighty. Let's go ahead and take a look at the market today. Let's take a look. QQQ stock. So taking a look at QQQ, the market was down 2.12%, and the S&P 500 was down 2%. So the market had a really rough day, mainly because Trump reignites fears of a trade war over Greenland, as we can see. Global markets plunged Tuesday after President Donald Trump reignites fear of U.S. trade war with the European Union, shows no signs of backing off his threat Saturday to hit 7 EU countries and the United Kingdom with new tariffs unless they support his push for American control of Greenland. So that's the main reason the market's selling off, is because Trump is potentially going to place some big tariffs on the EU. So also, if we go over, let's take a look at Netflix. Made a video on Netflix earlier. Netflix, the stock's down 5% after hours. So let's take a look at Netflix's earnings real quick. Taking a look at Netflix. Earnings per share, slight beat. Revenue was also a slight beat. Net income did rise a pretty good amount, and the revenue during the period rose 18% year over year, so that's good. They expect 2026 overall revenue to range between 50.7 to 51.7 billion. So let's look up a calculator to see how much of a gain that would be. They recently reported 45.2. Let's do this. So what do they expect on the middle range? We'll just say 51. 51 divided by 45.2. They're expecting a 12 to 13% year over year increase in revenue. So that's what they're expecting. The new update that it had agreed to acquire streamer HBO Max and the Warner Brothers film studio for $27.75 per Warner Brothers share, or an equity value of $72 billion. So let's just go over to Netflix on my valuation investing website. Let's take a deeper dive here. Financial statements, 43 billion, trailing 12 months, 33. So they're growing pretty good. Financial charts, revenue is increasing over time. EPS also growing. Total debt is really tanking for this company. So they're paying off a lot of debt. That looks good. Profit margins going up. Shares outstanding decreasing. Everything fundamentally looks good with Netflix here. So looking at the SunStep stock analysis, forward PE ratio is less than 30. Return on invested capital, 15.6%. Everything looks good for this company. Let's go to the intrinsic value calculator. Let's input some assumptions. Let's do 9, 12, and 15%. Future profit margin, let's do 23, 26, and 29. Let's do 23, 26, 29. Future PE ratio, 22. Let's do 27, 32. These are a bit higher assumptions than what I had in my video earlier. So let's just see what we get out of this. If we calculate the intrinsic values, 8.6% return from today's price. So once again, from today's price, Netflix still looks overvalued to me. I would want to buy this at $81.92. And if you guys have any stocks you want me to analyze, please let me know down in the comments. I'll be writing it down on a notebook for future reference. So if you guys have any questions about any stocks or just anything, put that in the comments. So let's open this notebook. We have some stocks to potentially look at for the future. Let's go over to the Discord, see what's going on. Let's see. Let's go over here. Let's watch the live stream real quick.
Excuse me, you're reading wrong. Put these on. Show me your book. I'm gonna take a picture of it. Now it's gonna scan it and read it to you.
As I sit here with one foot on either side of the ledge, looking down from 12
Let's see.
And I
stories
can increase the speed.
I can't help but think about suicide. Not my own. I like my life enough to want to see it through. I'm more focused on other people. And how they ultimately
And you can pick from hundreds of different voices, even celebrities like
Do they look at the ground as it rushes toward them and think?
Yes, you can literally pick from any book on the bookstore or
So yeah. Let's take a look at some upcoming earnings. Tomorrow we have Johnson & Johnson. Johnson & Johnson at $218. That's kind of crazy. Charles Schwab, also a lot higher. Prologis. We have Ally Financial, Travelers, and Halliburton Company. Then after that we have Kinder Morgan, Procter & Gamble, General Aerospace, GE Aerospace. So yeah, those are the companies we have coming up. Let's take a look at what's trending in the market right now. Netflix down 5.91%. GameStop is trending. Increased their stakes in the company. QQQ trending. Salesforce is really falling right now. That can be interesting to take a look at. So let's take a look at Salesforce here. Let's type in Salesforce. This could be interesting to just take a look at. Salesforce growing at 9%. Let's go over to Investing Pro and let's see if we can look up Salesforce. Let's see. Let's type in Salesforce future revenue growth. Whoops. Go to the charts. CRM. Salesforce. Now let's type in revenue. Revenue growth forecast. So analysts expect them to grow at about 10% for the next 5 years. That's pretty interesting. So if we just assume that they grow 10%, let's say 8, 10, 12. Future profit margin right now it's at 18. I expect them to potentially increase this profit margin back up to previous levels. Then future PE ratio, let's put 20, 24, 28. Let's look at the shares outstanding. They're decreasing at about 1% each year. So let's do negative 0.5, negative 1, negative 1.5. Click calculate intrinsic values. From today's price, get an 8% return. So that's me personally. I'm not too interested in Salesforce, especially at this price. That's just what I believe. So yeah, me personally, Salesforce just looks overvalued to me. Let's do a 10-year projection, see if this gives us any difference. 9.6% return. I highly doubt that Salesforce will give you good returns. That's just what I personally believe. So yeah, that's just my personal belief on this right now. Alright, so we also have some big news with the channel. If we go over to our channel, my channel, we can see 4.96k subscribers. So we're so close to 5,000 subs. So if you guys haven't already, please hit the subscribe button. If you haven't watched this new video too, I really enjoyed making this video. I'm buying these 10 stocks like crazy in 2026. I really like this video. I think this is a great video to watch. At Davin, that is very nice to hear. Join today to your platform. The website is good. I wonder if you have any insights on what should I make better, or what do you think? Or do you think it's good the way it is? I would like to know if there's anything I can improve. I'm trying to improve as much as possible with obviously the website. That would be that'd just be nice to know what you believe, what you think it is. So if we can make it in any better way, that would be amazing. I'd really enjoy trying to make this a better, just overall experience for anybody that is on the website. So if you have any suggestions, just leave it in the comment section. If you guys have any stocks you want me to analyze, I'll definitely take a look at those. Or anything you want me to take a look at, that would be good. Is there bar charts with the financial statements? Yeah, so just go to the financial charts. So look on my screen. I'm hovering around this. Just press the financial charts button. You can see the revenue, net income, EPS, shares outstanding, total debt, profit margin, free cash flow, and then the PE ratio over the past 4 to 5 years. So as we can see with Salesforce, they're really increasing this revenue pretty well. Net income also going crazy. Shares outstanding, they're buying back. Total debt decreasing by a lot. So yeah, just go over to the stock analysis area, go to the financial charts, and you can see that. You can see the stock price, financial statements. I try to make the financial statements pretty easy for people to understand. So let's take a look at Disney stock. Corey Dickerson has a company that he wants me to analyze. So let's take a look at Disney. So Disney, market cap $198 billion. Their PE ratio seems pretty low. Okay, we'll do Flowers after this, but PE ratio 16. That's a very low PE ratio. Free cash flow yield looks decent, but look at this debt. Negative $39 billion in net debt. So there's a lot of debt with this company. That's something to be worried about with Disney. Going to the financial charts, they're also barely growing this revenue. Shares outstanding, they are buying back a little bit, so that's good. Their profit margin is starting to get back to normal from COVID. That's good. The free cash flow is really skyrocketing, so that's at least good for Disney. But looking at the 7-step stock analysis, we get 2 out of the 7 key metrics. A lot of debt. They're slightly increasing shares. The only thing that's been good is the EPS growth. They're not good at reinvesting back into the business. If we go over here, let's just take a look at what analysts expect for the future of Disney. Revenue growth forecast. So analysts expect them to grow like 4 or 5%. So if we input these assumptions, let's just do 3, 4.5, and 6%. I think those are pretty fair numbers for Disney. Profit margin, I expect 12, 14, 16. I think their profit margin will start to increase a bit. For the PE ratio, honestly, you got to give this like a 10, maybe 12 PE ratio. Let's just do 10, 13. Actually, no. Let's give them a 12 since I do believe they have at least a decent moat. So let's do 12, 12, 14, 16. Now for the shares outstanding, they've been increasing. So let's do 1, 0.5, and then 0. I expect them to continue to increase these shares very slowly. And looking at this, I think you get a 2.6% return base case. If you believe this bull case, though, if you believe that they deserve this PE ratio and they're not going to change their shares and the future profit margin state goes up a bit, I think this could look like a decent buy today. But me personally, it looks a bit overvalued. Next, let's take a look at Flowers. Let's go to Flowers. So Flowers, I'm pretty sure, is just packaged bakery food products. They have Nature's Own, Dave's Color Bread, Wonder Canyon. They have a bunch of breads companies, so that's interesting. Market cap 2.33 billion, P ratio 12. Free cash flow yield is very high. This is trading at a low valuation. The only thing I don't like is the amount of debt. Looking at this debt, almost $1 billion in debt, and the company is only worth $2.3 billion. That's kind of a red flag to me, just how much debt this company has. The stock's really tanking lately. They're not really growing much at all. The EPS is not going anywhere. Me personally, I'm staying away from this company just due to the low growth of this company. I like to see a company growing at least 5%. That is honestly my minimum. If a company's not growing 5%, I don't see a point in trying to buy a company that's not growing in the future that you don't expect to grow. And with Flowers here, this doesn't look like great growth to me. If the EPS is decreasing, even if the valuation is very low, I'm one of those type of investors that even if the valuation is low, I'd rather just have a good company at a fair price than a bad company at a good price. That's just what I believe. What do you think about Hal's earnings tomorrow? I'm not too familiar with the business. Isn't it just, it's an oil business, I'm pretty sure. Let me just make sure. I think it is. More of an oil energy business. Yep, energy industry worldwide, drilling and evaluation. Honestly, I don't know how that's going to turn out. I don't know enough about oil companies. But I can just take a look at the financial charts. Obviously, the revenue, net income, it's all over the place. Basically, if you want to own this company, you just have to think crude oil will go up. That's the bottom line. If you don't think the company will go up, the crude oil prices won't go up. It's pretty hard to invest in companies like this because it basically follows the exact price of oil. See, it pretty much follows the price of oil as we can see on this chart. Oil had a huge rise back in 2021. Halliburton also had a huge rise as we can see. So honestly, if you're going to buy this company, if I were buying an oil company, I have to buy the best company out there. And what I mean by that is looking at the financial statements or the 7-step stock analysis. As we can see, this company has a decent amount of debt. Don't love that. I'd rather just buy a company like Chevron because this company debt to free cash flow is a bit high. When you compare to Chevron and Exxon, those companies don't have as much debt. So I'd rather just invest my money if I wanted to diversify into an oil gas company, I would just buy Chevron or Exxon. That's just what I believe. So if you have any more stocks you guys want me to look at, I'll happily analyze them. So yeah. And as we can see, the market had a really rough day today. Down 2.06% on the S&P 500, Nasdaq down 2.39%, Dow Jones down 1.76%. So the market had a really, really rough day today. Like I said, LNG, so OOMA. Let's see what that is. I've never heard of that company. Let's take a look at this. OOMA. Wireless internet connectivity. This is an interesting company. Never heard of it. So market cap 319 million. Very small cap stock. P ratio 145. So high P ratio right now. If I had to guess, they just became profitable. Yep, and that's the case. So this company just became profitable. They're not growing very fast. To me, it's just very hard to determine fair value price with a company that just turned profitable. Because you're not going to know the exact profit. You're not going to know a range of profit margins in the future. So it's going to be hard for you to understand where this company can go in the future. That's just my point of view. Let's take a look at Ramp. Ramp plus 9% revenue growth. $1.63 billion market cap. So these companies look very interesting. This looks very interesting. Net cash, $343 million. So they have a lot of cash, especially compared to their market cap. Taking a look at the financial charts, revenue 9% growth. Once again, this company just became profitable. So it's going to be very hard for you to get a good area where this company should be trading at. And if you think it's an interesting company, that's just up to you. Me personally, I don't like investing in companies that aren't profitable yet, so that's just my personal opinion. But they do look interesting potentially. Let's take a look at Toast. Toast is an interesting company. Mainly, as we can see, a cloud-based digital technology platform, mainly for the restaurant industry. If you go to restaurants, almost every single restaurant uses Toast. When taking a look at the market cap, $19.26 billion market cap for Toast. P ratio is pretty high though. Let's go taking a look at Toast. Financial statements here. Let me just do something real quick. Let's see. So responding to you at JUEXJUE, in what video did I say I'd buy it around $82 per share? I would just like you to let me know what video. Let me try and find that. Which video is that from? Was that the one from 2 months ago? I don't ever remember saying I'd buy Netflix at $82. I've said in a past video, I said I'd be interesting at 800. With the stock split at $80, I said I'd be interested to do further research. I never said I'd be buying it at $82. I don't think, unless I'm missing something. But I've always said I would start to get interested at 80. Now I've revised my thought process. Doing more research with Netflix, I think it has to be in the 70s for me to potentially buy. Has to be in the 70 area. So when I said that I never said I'd be buying at 82. Let me see. What I meant by that is that's where I think you can make a 10% return. Me personally, I try to aim for 13%. So at whatever price I think I can make 13%, that's when I would be buying the stock. And for me with Netflix, that has to be 70. And also with this live today, I did more aggressive numbers. Yeah, I did more aggressive numbers for today just to show you why I still think I wouldn't be buying the stock today. And those were above analyst expectations, so that's why I showed that. But yeah, that's why in this live it showed $82, but in my video just a few hours ago showed $72 or $71. So that's the reason why. But getting back to Toast here, let's go over to the financial charts. Toast is a very good company. I think they have a very good moat, honestly. The thing I don't love is the shares outstanding. Profit margins continue to increase. Let's go over search. Let's put in T-O-S-T, Toast. Taking a look at Toast, they're expected to grow about 15% or so. So if we just input some assumptions, let's just do 8. Let's do 10, 14, and 18% revenue growth. I think that's fair for this company. Future profit margin, this is going to be hard. I'm going to do 5, 10, and 15. Right now it's at 4. I think it's definitely going to increase, but it's just hard to determine exactly where the profit margin will be in the future. But we're just going to put this for now. Future P ratio, let's do 20. Let's do 23. Base case, let's do 30. Then 37. Shares outstanding, though, I think they're 4% increase in shares. So let's do 4 or 5, 4, and 3. Let's see what we get for Toast. 8.2% return. So I have been interested in this company. It's just a little bit too hard to determine due to the profit margins. Right now, I think I would have to have more margin of safety. If I were to buy Toast, it would be at $25, I would say. Let's take a look at EME. EMCOR provides electrical and mechanical construction and facilities. So $31 billion market cap, decent PE ratio, decent free cash flow yield, pretty good net cash. They have more cash than debt. That looks very good. The profit margin is pretty low, but doesn't necessarily mean anything. They're growing 14%, growing 45%. This looks pretty interesting. This could be an interesting company to take a look at. Let's see. EMCOR. They're expected to grow about 8 to 10% in the future. So the reason I'm looking at analyst expectations for this is just because I don't know enough about most of these companies. I'll take a look at LNG after this one. Future profit margin, let's just do 6, 8, 10. Future PE ratio, let's do 18. 22, 26. Share change. How much are they buying back? Wow, they're buying back a lot of shares. This company looks very interesting. They have huge buybacks. -3, -4, -5. Calculate the intrinsic values here. 11.4% return. So this company looks interesting. I'm going to write this down. Let me see. I'm going to write this down in my notebook. So we're going to be taking a look at EME. This looks pretty interesting if there's a dip in the price. Let's take a look at LNG. Then we'll take a look at Spotify. And by the way, I did make a Spotify video a while ago. It was like 8 months ago, maybe. I made a video a long time ago. I've been thinking about making a video. I want to wait for earnings though. I really like to wait till earnings to make videos on companies because it gets more views and just spreads the word more. Let's take a look at LNG. LNG, natural gas. So me personally, it's a commodity company, so it's really hard to predict what a fair value price is. The one thing I don't like is this debt. So me personally, I'm already staying away from this company. That's just what I believe. The reason I'm saying this, and don't just sell or do anything just because I'm saying this, but look at the amount of debt this company has. -$25 billion in net cash. They have $26 billion in debt. The market cap's $44 billion. This is an insane amount of debt. Me personally, that's just too scary for me. I would not want to invest in a company with that much debt because looking at the amount of net income, let's take a look at the net income. Net income, they've been losing money every single year. So yeah, I'm staying away from this company. That's just what I believe. Let's take a look at Spotify. I think Spotify is still probably overvalued, but that's just what I believe. If you don't know what Spotify is mainly just a music streaming platform. So PE ratio 65-35. Pretty high PE ratio. Free cash flow yield very low. They do have a lot of net cash though. That's something to keep in mind. $6 billion is very good for Spotify. Looking at Spotify here, they're expected to grow about 10 to 12% each year. So with that in mind, if they continue to grow at that pace, I still think this company is probably overvalued. I also don't like how they're increasing shares. If we put in some assumptions, say they grow 12%, let's do 10, 12, 14. Future profit margin, only 8% profit margin is interesting to me. Let's do 8, 10, 12 for Spotify. Let's see. Yeah, 8, 10, 12 I think is fair. I think they can definitely get this profit margin up. Future PE ratio, I'm going to do 24, 28, 32. Shares outstanding, they're increasing 2 every single year, 2%. So, and I think they're going to continue to do that. Calculating our intrinsic values here, and what we get is negative returns base case. So, me personally, I think this company is very overvalued. Maybe I'm undervaluing how much of a moat this company has, but me personally, with the growth rate numbers, maybe I'm underestimating the profit margin. Say it gets to 15%. That's still a crazy increase in 5 years. But if it does, that I still don't think this company's worth it. So that's just my belief. Spotify just looks overvalued. So let's take a look. If you guys have any more stocks, just let me know. Just comment what stocks you want me to take a look at. So let's take a look at Sprouts Farmers Market. I know this stock, I was very interested in this company. It was like $20, $30. Sadly didn't get into it, but look at the stock price. Down 50%. But this has been a roller coaster of a stock. Look at the past 5 years. It was at $20 and rose all the way up to $150+. Now it's back down to 70. This company is very interesting, though. I think the problem is they don't have a huge moat, but nonetheless, this company is an interesting company. Let's go to the revenue growth forecast. Put in Sprouts Farmers Market. Revenue growth expected to grow 9-ish%, 9 to 10%. If they can grow that fast, I would actually be surprised. And if they do, I think this company could be a good buy. I wonder why the stock is falling, though. Let's do 7, 9, and 11. Future profit margin, 6% profit margin is very high for this company. Let's do 5, 6, and 7. Future PE ratio, 18. Base case, let's do 22, then 26. Shares outstanding, they've been buying back almost 2%. So let's do 1, -1, -2, -3. I have a feeling this could be huge numbers here. 22% return with Sprouts Farmers Market. 22%. I have to put this on the list. Sprouts Farmers Market looks very interesting from this price. I want to take a look at why the stock is falling. Let's look up Google Gemini. Let's just ask, why is the stock falling? Whoops. Why is Sprouts Farmers Market falling? So a lot of insider selling, legal pressures too. So that's one thing you gotta watch out. Their weak outlook is very interesting. Growth of only 0 to 2% of comparable store sales. So with the valuation, this company looks interesting. The problem is with these recent headlines, it looks a bit risky just with those recent headlines though. Let's put these numbers in. Let's put conservative numbers to see. With these numbers, you still get 15% return, so yeah, this is interesting. Net income really growing, shares outstanding decreasing, profit margins increasing. Let's take a look at the 7-step stock. Yeah, it makes sense. The debt is a little bit high, but it's still not bad. For a company like Sprouts Farmers Market, it's not the worst. Obviously, I would wish it to lower, but it still looks pretty good. This company is definitely interesting, though. Let's take a look at FICO. FICO, I've made plenty of videos on. This company is a very high quality company. It's just, I think it's overvalued. That's my basis with most of these companies. Most of these companies are just a bit overvalued for me. Type in FICO for the revenue growth. Let's see. They're expected to grow about 15 to 16% per year. Let's put some revenue growth assumptions. Let's see. Let's do 12, 15, 18. Future profit margin. Right now it's at 32%. I don't see this going anywhere anytime soon. FICO is the main and almost the only company that does these credit ratings-based credit scores. They're the main company that does this, and I don't think it's going anywhere anytime soon. Future PE ratio, a company growing 12%. I would say 28 PE ratio sounds about right. I'll say, yeah. Let's do 26. Base case, 32. Bull case, let's do 38. Shares outstanding, I'm pretty sure they've been buying back a good amount. About 2% a year. -1, -2, -3. This looks fair to me. Calculate. See, 5.7% return. Me personally, I just think it's an overvalued company. I think the company's a great company, don't get me wrong, but from today's price, I just think it's a little bit too overvalued. Let's take a look at Intuit. I took a look at Pinterest the other day. I believe Pinterest is overvalued. The reason I say that is because even though Pinterest PE ratio looks pretty good, the reason it looks good is because of some accounting benefits. So in reality, their P ratio is a lot higher than what people think. But taking a look at Intuit, I know the stock has been really getting hit. As we can see with Intuit, market cap $147 billion. P ratio is a bit elevated. Look at the financial statements here. Cash. 2.8 billion in cash. They do have some debt, not a crazy amount though. Intrinsic values. Let's look at Intuit. I'm assuming they're going to be growing about 8 to 10% per year if I had to guess for Intuit. And actually, no, they're expected to grow about 12% a year. So let's do 8, 11, 14. Future profit margin, let's do 20, 23, 26. I think they're going to increase this profit margin. Future PE ratio. Let's do 20, 25, 30. Now for shares outstanding, I think it'll decrease maybe 0.5% per year. 0.5%. Calculate this. 5% return from today's price. Me personally, once again, Intuit just looks a bit overvalued. That's just what I believe. Let's take a look at Melli. Mercado Libre. Mercado Libre is trading at a very high valuation. Free cash flow doesn't look great. They're growing very fast though. Very fast growth company. They're expected to grow near 20% each year. So with Mercado Libre, let's do 15, 20, 25, honestly. 15, 20, 25 I think could be fair for this company. Future profit margin, let's do 7. Yeah, let's do 7, 9, and 11. Future PE ratio. This is where it gets a bit tricky here. Let's just give it a 30 PE ratio at first, 40, then 50 with this fast growth. Then shares outstanding, they're increasing 0.2%. So let's do 0.5, 0.25, and then 0. Calculate. 17.6% return from today's price. That is assuming 20% growth. I think that could be a little bit high. If we did 10, 15, 20, And I think 40p ratio would be high for this company. 35. Let's do 20. Let's do 20, 35, 50. These could be very high PE ratios. Honestly, I think you just have to do enough research. If you believe this company can grow 20% or higher, then it's definitely a buy. I'm not well versed enough to know about Mercado Libre just because it's not really in the US. I need to do more research on this company. Let's take a look at Chewy. Chewy, $13.68 billion market cap. I'm already going to say, I don't know. I think the current P ratio is too high. That's just what I believe. I think the current P ratio is too high for this company growing. What's the next one? So what platform is this? This is valuationinvesting.money. I created this platform for my own use, for the use of the channel, and I'm also letting you guys have it. I think at a very cheap price, $8 per month, 7-day free trial. If you want to go check it out, let me give you the link. You can get a 7-day free trial if you really want. Let's put this in the chat. Valuationinvesting.money. That is the platform I'm using, and it's what I've created. Let's take a look at PayPal. PayPal, you're gonna look. I think PayPal is just a value trap. The reason I say this is because I believe PayPal has a very bad moat. That's just my belief. I think PayPal does not have a good moat, and that's what's keeping me away from this company. I think the moat is deteriorating insanely fast, and their growth is decelerating fast. Even though the valuation looks good, I just don't believe this company will grow well. They're expected to grow about 6% each year. Let's input 4, 6, 8. Future profit margin. I'm going to expect this to say decrease slightly. Let's do 13, 14, 15. Future PE ratio. Let's do 13 for the bear case. Let's do 16 and a 19. Now for the shares outstanding, I think they're going to be buying back a lot. Negative 5% per year. Let's do negative 3, negative 4, and negative 5. 17.2% annual return. So guys, even though it says you're going to get a great return, doesn't mean you should buy it. The reason I'm saying this, I also have a rule with myself. I need to buy companies that are growing at least this rate, at least. And the problem I have with this company is just the moat of this company. Look at all of the competitors with PayPal. You have Apple Pay, Google Pay. You have all these other places. I personally don't even like PayPal myself. I do have a PayPal account, but I just believe PayPal. And you also have a lot of competitors with Cash App. You have competitors with Cash App. You got a competitor. That's another competitor with them. Because PayPal owns, whoops, what did I do here? Double click, let me get out. Because as we know, PayPal does own Venmo. And they also have a lot of issues. And Honey has had a lot of legal issues. That's just what I believe here. Taking a look at the next stock. Let's take a look at Uber. Uber's going to be a hard one to analyze. Let's take a look here. because with the earnings overview of Uber, it's going to show you a story that looks like it should be very good because look at the financial charts. Back in 2024, you had a huge spike in EPS. Now you see it go down, and the reason for this, I'm pretty sure, is an accounting spike. Yeah, net income of 6.6, but 4.9 billion. So they actually had 2.3 billion or so. 2.3 billion in net income this year. Which year was it? Let's see. In 2024. Let's see. Let's take a look. What would Uber's profit margin be without the accounting spike? Because you can't just look at that and believe their profit margin will stay there. Technically, they are barely profitable, as we can see. So that's actually crazy. That's insane to see. So this is going to be hard to predict what their profit margin will be in the future, but I'll try my best. Do I think they're going to have no profit next quarter or whatever? Probably not. They're expected to grow about 12% each year. Let's do 8, 12, 16. Future profit margin, let's do 5, 10, 15. Future PE ratio, let's do 20. Let's do 27 and 34. Shares outstanding, are they buying back shares? No, they are not. They're increasing shares by about 2 to 3% each year, so 3, 2, and 1. Calculate the intrinsic values here for Uber. 3.9% return. It just depends on what you think the profit margin will be in the future. Obviously, the profit margin, as we see here, if you put this profit margin in for base case, you're going to get amazing returns, 31.9%. But in reality, this company's profit margin is like 12, in the low 1s to 12%. If you think they can get 15% profit margin, then I would say this company looks interesting. Like I said, though, I think it's a little bit overvalued right now. That's just what my belief is with Uber due to these accounting spikes. So, yeah. Let's look at Clorox. Clorox, 13 billion market cap. Free cash flow yield looks pretty good. Net cash, though, negative 3 billion, not great. Some step stock analysis. Me personally, I would stay away from this company. Revenue is going down. I just don't want to invest in a company with a revenue decreasing over time. That's just my belief. Let's take a look at NICE. I've definitely looked at this company before. AI-powered cloud platforms for customer engagement and financial crime and compliance worldwide. $6.9 billion market cap, P ratio 12. This stock has been down a lot because I remember this stock was a lot higher. Net cash $369 million. That's good. Financial charts, revenue looks good. Net income looks good. Profit margins look good. Everything looks good with this company. Total debt looks amazing. Everything looks good besides the return on invested capital, but so far it looks good. Nice. They're expected to grow about 8% each year. Makes sense. Let's do 6, 8, 10. Future profit margin. Right now, 19%. Let's just do 18, 20, 22. Future PE ratio. Let's do 15, 19, 23. Shares outstanding. They're barely buying back, so 0. Let's do 0.25, negative 0.25, then negative 0.5. Let's calculate this. 18% return here for nice. Let's reduce this profit margin. Let's reduce the revenue. 18. And if we calculate this still, we get 12% return. So this company looks interesting. So nice looks like an interesting company. Just gotta do more research. Musa stock. So yeah, once again, this company is a basically gas company. So I don't have much to say, but the share buyback, 6% per year, that looks good. The thing I don't love is the debt. The debt is pretty bad. Ordinary total debt, $2.3 billion with 470 mil. The debt is pretty high. It's not terrible, but it is pretty high. Me personally, this company looks interesting if you're looking for a company. If you're looking for a company for oil, then it might look interesting. What is your NFL team? I'm a fan of the 49ers, so yeah. Not great to be a 49ers fan in the past week, but let's look at Micron. I think this will be the last one of the day. 410 bill. I remember in a video when I made this on Micron, I said this company looks very interesting. I think it could be a buy. Sadly, am I buying Adobe stock? Right now, no. I said in my past video, if it gets to 270, then I'll start to add more. Let's just go over Adobe at the end. Then that will be the last stock I'll be taking a look at here. Micron, though, debt to free cash flow is very high. But the reason for that is the free cash flow has been... Hold up. No, they actually have a lot of debt. But they do have a lot of cash, so that's fine. For Micron, let's see. Micron growth rate. It's all over the place. It's going to be hard for you to determine a fair value price with Micron. I'd say do 18, 10, 18, 26. Future profit margin. It's going to be really hard. Micron is a very cyclical company, so it's going to be hard to determine a fair value price. Let's do 25, 30, 35. Let's take a look. They're increasing shares, so one thing I don't love. 15% return, though, from today. If you think they can grow 18%, but in reality, I think 15% would be fair. So, I mean, it still doesn't look bad for Micron. Do I have a LinkedIn? Yes, I do have a LinkedIn. I can share my LinkedIn in the chat. Let's see. Let's see, how do I share this? Let's see if I can find this. Okay, so hopefully that works. But let's go into the final stock of the day, Adobe. So take a look at Adobe. They're growing about 10.5% each year. Take a look at analyst expectations. So I've said I would buy Adobe if I think I can make, I would buy, my main basis is first I'll buy a stock if I think I can make 13 to 15%. That's when I'll start a position. Then I'll start to load up once I get 18 to 20% return. Then after that, it's just even more buying from there. That's my thought process. And with Adobe, they're expected to grow about 9% per year. So with that in mind, let's input some assumptions. Let's actually do 7, 8.5, and 10. Let's be conservative. Future profit margin, 25, 27, 31, I think. That will be a pretty conservative number too. Right now, their profit margin at 30. Future PE ratio, let's do 18, 21, 24. Shares outstanding. They've been buying back at about 3% each year, so I expect them to continue that rate. So let's do negative 3.5, negative 4.5. They've been buying back a lot, so let's calculate the intrinsic values for Adobe. See, from today, I expect a 15.1% return. So me personally, like I said in the past, I would want to buy this company about $270 per share. If I wanted to buy this company, it would have to be at $270, I would say. That's just my assumption, and we can go over, actually, let's find this. Let's go over here to show you exactly what price I would want to pay for Adobe. We have to insert the revenue number. Let's go over here. 23,769. 23,769 00000. This should be accurate, hopefully. Yeah. So 7, 8.5. Then we got 10%. Future profit margin, like I said, let's do 25. Let's do 25, 27, 29, actually. Let's keep it even lower. Future PE ratio. Let's see what I had over here. I think it was 16. 18. So yeah, 18 PE ratio I think is fair. Then 21, 24. Shares outstanding, negative. Let's do negative 3. Let's make sure. They're buying back at 3.5%. Let's do negative 3, negative 3.5, and negative 4. So from today's price, I think you can make 15% return. But I said I would be continuing to buy a stock if it was at, say, 18%. So if we input some assumptions, 275 share price, 16% return. So actually, I think I would start buying more under 270. If we get under $270, I'd start adding more to my position, because even with the bear case for Adobe, I get almost a 10% return with the bear case. So if we get to $265, that's where I would start to buy this company. So yeah. But from today's price, I think we can make 15% return. From my average price, let's put 310. I think I can make almost 14%. So for my average price with conservative numbers, if we do some better numbers that I think can still occur, I think you can make 17% from there. And if it got to 270, I think you can make 20% with these assumptions. So this is why I'm saying I need this to be at $270. If it gets to 270 Adobe, then I'm going to start to load the boat a little bit more. The only reason I'm not going to continue to buy is because I think it's more risky. So aren't you concerned with Adobe's moat? I'm a bit more concerned with Adobe's moat than compared to what Google was, but look back in time in early 2025, late 2024, people were so concerned about Google's moat. The stock was trading at a very cheap valuation. We can pull this up. Let's look up Investing Pro. So many S&P 500 companies already use Adobe. I think it's 99%. Let's see how much. I'm pretty sure 99% use Adobe, but let's go ahead and take a look at the PE ratios for Google. Let's see. Let's see if we can take a look. PE ratio. Look, Google's PE ratio is at 18. 18 when huge sell-off. Everybody was worried about their moat. Obviously, if I went back in time, I would rather get I'd rather get Google at this 18 PE ratio than Adobe at the 17. I do believe that Adobe is under more threat than Google was than back then. But I do believe that Adobe is still likely to be around. I still believe Adobe is going to continue to grow at a very consistent rate. As we can see, almost 100% of the S&P 500 uses Adobe. Fortune 100, 99%. Fortune 500, 90%. So many of these companies use this Adobe. Also, Firefly AI, 75% use it. That's why I believe that this company is a great company to own. Now, I never followed up on the investing bootcamp videos because they're getting not much views, so they're not getting views at all, honestly. So, decided to switch my focus more towards live streams or this type of content. So I think this is going to be it for this video. Thank you guys for watching the live streams. Thank you for sticking around, making it a good live stream. At what price would you buy NICE? Honestly, not sure yet. I would have to do more research on the business as a whole. If those assumptions were true, then I would buy it today. But who knows? But I just want to say thank you guys for joining in on this live stream. Please subscribe if you haven't already. We're so close to 5,000 subscribers. We're within like 30, 40. It would be great if you guys did subscribe and also like. What link on my video description is broken? If you don't mind telling me. Oh, the Discord. Okay, let me go fix that real quick. Let me fix the Discord. Let's see. Let me fix the Discord link real quick. then that will be all for me today. So thank you guys for watching this live stream. Please subscribe, hit the like button, comment down below. And I'm going to try and live stream as much as possible around this time every day. I'm going to be trying to live stream as much as I can around 8 o'clock, I would say, on weekdays. I'm going to be trying to. So if you guys enjoy